We've all heard about the stock market, buying a piece of Apple or Amazon on an exchange. But lately, there's been a lot of buzz about a different type of asset class, private markets. Traditionally, this was a members-only club for billionaires and massive pension funds. But in recent years, the doors have swung open to everyday investors. In this video, we'll break down what private markets are, how they fit into your investment portfolio, and if they're right for you. If we haven't met, my name is Mike Daniels. I'm a wealth advisor dedicated to helping busy professionals pursue their financial independence as early as possible. Simply put, private markets are where you invest in companies or assets that aren't traded on a public stock exchange. When you buy a stock in your 401k or brokerage account, you're in the public market. But most US companies with over $100 million in revenue are actually private. Private markets allow you to own a piece of these companies directly. Everything from hot tech startups like SpaceX to local apartment complexes or even large-scale infrastructure like toll roads. There are three main types of private markets that you'll hear about. The first is private equity, buying an ownership stake in a private company. Think of it as being a part owner of a business before it's available in the public stock market. The second is private credit. This is like being a bank. You lend money directly to companies that need it for growth. In return, you get steady interest payments, often higher than what you get from a traditional bond. The third is real assets. This includes things you can touch like real estate, warehouses, or even digital infrastructure like AI data centers. For most of us, our 401k or IRA is our main investment vehicle. Some investment professionals suggest using private markets as a diversifier. For example, a small slice, maybe 5 to 20% of your total portfolio. The value proposition is that private markets don't always move in sync with the stock or bond markets. For example, if the S&P 500 is a bad day, your private investments may remain steady or even rise, helping to smooth out the volatility of your experience while investing. Like anything in finance, there are pros and cons to including certain investments in a portfolio. Here's the breakdown. The pros of investing in private markets: higher potential returns. Historically, private equity has outperformed public stocks. Lower volatility. Since these aren't traded every second on an exchange, their values don't jump around as much day to day. The cons: lockup periods or illiquidity. This is important. Often, you cannot sell these investments immediately if you need cash right away. Your money may be locked up for weeks, months, or even years. Higher fees. Managing private deals takes a lot of work, so the fees are typically higher than a standard index fund. Less transparency. Private companies don't have to release as much public data as companies like Starbucks or Nvidia. So how do you actually invest in private markets? Your 401k or brokerage account. Certain financial institutions offer funds such as target date funds that give exposure to private markets. 401k plans are slowly adding exposure to private markets as we speak. Evergreen funds. These are funds that you can buy through a brokerage that act a bit more like a regular mutual fund but invest in private deals. Private markets can be a powerful tool, but they aren't for everyone. They require a long-term mindset and may be illiquid if you need your money back sooner than later. As we roll through 2026, keep an eye on your 401k for plan updates. Your employer may open the door to this asset class. As always, thanks for watching and see you next time.